Hello, I'm Clara Hermit and this is Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
I'm very well, Clara. How are you?
Not too bad.
Lovely to see you again.
Been enjoying the sunshine?
Yes, very much so. Thank you, down by the sea. It's been lovely, thank you.
Good. Russ, what's the fuss?
Okay, well, the next week could be very, very, very quiet when it comes to corporate news, as there are very, very few results actually scheduled. So that means macro events are likely to dominate yet again. That probably means the fuss is going to be about Greece, which continues to dominate the headlines, and as you can already see, it's actually shaping sentiment of UK investors in the market right now. This first chart here simply measures the performance year to date of the leading indices ranked from best to worst in percentage terms. Now, as you can see, the FTSE 250 is top with a gain of around 10%. Now, that's closely followed by the very much maligned AIM All Share Index, and then the FTSE Small Cap. They're both up around 8%. Tail end Charlie over here, that's the FTSE 100, up just 1% in capital terms, even though dividend payments will bump up the total return a little bit and make it a bit more respectable.
Now, Russ, that's all well and good, but what's the link between small and mid caps doing well and Greece frightening everyone?
Okay, that is a perfectly fair question, and the answer is home comforts. Simple as that. Exactly the trend I outlined in last week's slot when I took a look at sector trends in the UK market. Now, I don't want to sound like a cracked record, but I did point out back then that the industrial transport, real estate investment and services, household goods and home construction sectors were amongst the Q2's top 5 performers out of the 39 industrial groupings that make up the FTSE All Share. Well, this theme makes sense in the context of the leading indices too, because around 2/3 of the FTSE 100's earnings come from overseas, while the 250, the small cap and AIM, generally have a much greater domestic focus here on the UK. So as such, it looks as if the market, for now, seems more confident in the prospects for the UK's recovery than it does in those of key export markets such as the European Union, which as a bloc is actually our single largest trading partner. Now that's why an event in Athens could cause a fuss. Even if Greece is barely 2% of Eurozone GDP, the consensus is there will be very little contagion. Greek debt's now mainly held by the EU, European Central Bank and International Monetary Fund, rather than the banks, and Greece is small. So if, and it's a big if, that contagion is small, maybe the exporters and stocks with international exposure might close the performance gap. But obviously somebody somewhere right now isn't entirely convinced, given that apparent preference for domestic bliss.
Yeah, domestic bliss, something we all look for.
Yes, absolutely.
Are there any sector trends that we should note?
Yes, definitely. Well, the FTSE 100's overall mix, always worthy of consideration. Between them, banks, insurers, oil and miners, a rogues gallery if ever there was one, represents around 43% of the market cap, just over half of aggregate profits and dividend payments for 2015. So to buy an index through a tracker fund, buy that index through a tracker fund or an exchange traded fund, ETF, you therefore need to be very comfortable with heavy exposure to those 4 sectors, and they can be volatile, complex and unpredictable. Now the following charts come from our good friends at Shares Magazine, the usual ones, ranking year-to-date percentage gain of all the individual sectors in the All Share from 1 as the best and 39 as the worst. Banks, oils, miners, all ranked towards the bottom right now. For the FTSE 100 to therefore get back to around the 7,000, 7,100 mark, those 3 have got to get a wiggle on in the second half of the year.
Well, at least banks look to be trying to stage a rally by the look of the chart.
They are, except for obviously the Barclays chief executive's just got the tin tack this week. But yes, it does. Financials worldwide actually improved in Q2 using the dollar-priced S&P 1200 as a benchmark. Now this next graphic shows financials, energy and materials ranked 1 to 12 on their weekly performance. And again, financials worldwide are on the up. Commodities, energy materials, flat as a pancake. So if there is any Greek contagion, it'll be interesting to see how the banks handle it. The next chart comes from some fab research from XN BNP Paribas, French investment bank, and it shows which sectors did best and worst on a relative basis on average during 4 prior periods of Greek-inspired market turmoil since 2010. The best, defensives. Food and beverage, healthcare, household goods, areas that are around a quarter of the FTSE 100, interestingly. The worst, basic resources, insurance, banks, bit less encouraging. Now, that was for Europe, not the UK, I hasten to add, but if there is contagion and spillover in terms of market sentiment, it'll be interesting to see how those sectors perform and whether they do keep weighing on the FTSE 100 and disadvantage it relative to those indices with a greater home focus.
Okay, thank you, Russ. And thank you to you for joining us. We'll see you next time. Goodbye.